Good afternoon, everyone. Welcome to the earnings release of the second quarter 2020 of EDP Energias do Brasil. I am Maria Nogueira, Executive IR Manager of the company. The presentation today is going to be made by Miguel Setas, CEO and IR Officer, and Henrique Freire, Vice President Finance. This webcast is exclusively being web, posted on the web at the following address: ri.edp.com.br. The webcast is being recorded and is going to be made available on the company's IR website. At the end of the presentation, we are going to have a Q&A session. Please ask your questions on the webcast platform. Before moving on, I would like to let you know that any statement made during this webcast relative to the company's business outlook, operating and financial goals and projections are based on the beliefs and assumptions of EDP's management and rely on information currently available to the company on the website and also through CV. Forward-looking statements are not a guarantee of performance, since they involve risk, uncertainties, and assumptions, and because they refer to future events and therefore depend on circumstances that may or may not occur. In that, I'm going to turn the call to Miguel to start the presentation. Please, Miguel, you may go on. Thanks, Marilia. I'd like to welcome you all to the second web conference of the year to discuss the earnings of the second quarter 2020. Today, we are going to have an experience, a different release. It is the first time that we are testing the webinar technology, and we hope it is a model that is easy to interact and that will enable us to follow this presentation with quality. So I would like to tell you that we are very much aware that this is a sensitive moment for the country, not only for EDP, but for the whole of Brazil. And we hope that you're all healthy and right now that everyone is at home and working, but safe and protected from the pandemic. This is my first comment. This is a quarter that is, I would say, quite special, quite important for us. It is a quarter in which we started to see an inversion of results. You are going to see, and we are going to explain that throughout the presentation. Most our results compared to our records of 2019 have changed, and it's also a quarter in which we are going to make an important announcement. Not only an adjustment to our dividend payout policy, but also a start of a buyback program. And in the end, I'm going to give you an explanation about the objectives that we have with the adjustment of our policies and the program. If you could please go to the first slide. I would like to tell you a bit about what our agenda is going to be like today. So we are going to first talk about how the company positioned itself before the pandemic, the strategy adopted to react to the current context. Then a second chapter of the presentation is that is going to be presented by Henrique, our CFO, will address the quarter results, and then we are going to talk about the adjustments on the dividend policy and the share buyback program that is going to start as of today for a period of 18 months. So please, if we can go to the next slide. Well, this basically to show you that we have adopted a threefold strategy that we call it the 3R strategy: react, recover, and reshape. And basically, the first R, react, it was the first month that we are reacting to the pandemic. We put together a crisis committee that met daily, and this crisis committee is still operating. And we have six sub-dimensions, so people's health care, operating issues, financial issues, supply chain, our value chain, uh, legal regulatory issues, and finally, communication and society. So these six subcommittees were used for us to take measures, immediate measures on the pandemic, which enabled us to react timely and cautiously to what was going on around us. And here on the slide is just a brief summary that shows that we have adopted measures that enabled us to safeguard the company's cash at about 3.1 billion reals, of which 1.35 comes from a reduction of total capex and opex, a reduction of dividends, and the cancellation of an M&A project, and also a reinforcement of our liquidity with 1.75 billion reals by refinancing and rolling over debts, additional debts that were issued that enabled us to reinforce our cash position. And we are going to see that in Henrique's presentation further on. A second part of our reaction, or after the react, we had the recover, which is the phase we are now in. Basically, the idea is to recover, and we want a full recovery of all the impacts of COVID-19 on our operations and on our accounts. And we want that to last until the end of the year. We have a plan with about 50 initiatives that aims to um, shorten, so to speak, the estimated impact of the pandemic on our operations or lessen the impact. And this is again something that we monitor on a weekly basis. 50 initiatives, as I mentioned, to optimize our cost structure, to resume and accelerate our construction work, to manage our regulatory agenda, to manage our contingencies, a very thorough plan that aims to recover the impacts of COVID-19. If we hadn't adopted the plan, we could have an impact of 2 digits on company accounts. So on a weekly basis, we are following up with those responsible for each initiative, really strictly managing our recovery plan. And third, which we have already started working on, which is, as I mentioned, the reshape. The way we are working on reshape today is basically by means of opportunities committees on the topics that you see on the slide. So that is committees focused on growth, customer relations, our digitalization program, innovations initiatives, green recovery initiatives, that is our environmental agenda, initiatives that are more socially driven, that is to manage our people, which we call diversity and inclusion initiative, and finally, a new normal way of working, which we call workplace redesign. So those committees will meet every 15 days, and then we address this topic in our meetings, and they are allowing us to push the agenda to create value, already focusing on the future and the opportunities that the company has ahead, uh, basically to use the crisis to fully strengthen ourselves with a full political coherent strategy. And finally, I would like to make it very clear, in this quarter, with the board of directors yesterday made the decision to adjust its dividend policy. We're going to see that in more detail further on. Basically, to give more transparency and safety to our investors. Um, basically on the way that we can generate our cash flow and we pay out dividends. And also implied in this dividend policy and how it was structured, there is an optimization of our capital structure. And we are going to see that again further on. And basically, for everyone to be aware that investing in the company is profitable with a price interval today. We believe that investing in our share is a good decision, and therefore we are having a share a buyback plan that again obviously has this vision of creating value with our base of investors. So I believe this is a truly important quarter. It is the turnaround quarter. We have a full strategy in place, not only to react, but recover results and reshape our impact in the future with the options that we have ahead of ourselves. And certainly the scenario of crisis help us also to use opportunities to create value to us all. Oh, well, all that said, Enrique, I have finished with my introduction and I'm going to turn to you and I'll come back to talk about the readjustment and a share buyback program. Hello, everyone. So we are going to start with slide number 5. So here I'm going to talk about the highlights of the quarter. This is obviously the COVID quarter. Uh, and I think that we were able to present results beyond expected. First, I would like to talk about the most important highlights in each one of the business. So in generation, trading, and services, uh, and the solar distributed energy, we won 2 bids with 14.3 megawatts in contracted power. We also, in terms of hydrological risk of coverage, we have an allocation of additional energy more to the second half of the year. And in transmission, basically, we had the good news of the uh, startup of lot 11 and 12 months ahead of the regulatory deadline, which is very good news. Altogether, we are adding more than 40 million in additional capex to the structure, so very robust. We have 71 of the total capex already executed. So we are, even with the downtime that we had, I'm going to talk about further on, we are now in full speed. Talking about distribution, uh, basically because of the Conta COVID, we already received 574 million, 92% of the total allocated for EDP as cash reinforcement. We received that in the second quarter. We are now discussing the economic clauses related to that. We had also the first tariff readjustment that was negotiated with a rate of 2.55%, and we continue to have a stronger position in Selects with an acquisition of 5.72 shares, and with that we have 28% of the total Celeste capital. In terms of our operational and financial performance, we have been able to reduce our operating costs, nominal numbers of more than 800, and with that we have net earnings of 25% compared to last year. Net debt adjusted EBITDA is at 2 times the ratio, because of the CapEx evolutions that we had. And also it was the months that we joined the UN's initiative, the business ambition for 1.5 degrees centigrade. And with that, we uh, we are joining efforts of EDP worldwide and also EDP Brasil. In terms of donation, also very important, which shows our commitment to society in the communities and societies in which we are inserted. And at difficult times, we made donations in the amount of over 10 million reals to fight the pandemic in the areas in which we are inserted. This is the commitment that we have with the society. Please, the next slide. Well, basically, this is our EBITDA evolution. COVID obviously had something that affected us. We had a drop in our distribution market. Our generator also, because of the flexibility of the contract, was also affected. Distribution, some companies were above the 5% limit, and that led us to record the purchase of that energy vis-à-vis the spot prices. So there is a difference compared to last year, and that partially justifies what we have in terms of 23 million for distribution. In transmission, this is the accounting entry. We have the completion of work. So although there was a slowdown, we have a positive number. Hydro generation, we still see a positive evolution compared to last year, and PECEM, not with much dispatch in the period, but with a number that was very much aligned with the data, and that helped us with our operational costs in the period. If we can go to the next slide. Here we talk a bit about distribution. Well, first, our adjusted EBITDA. Generally, we have an entry which is a non-accounting entry, which has our assets. Uh, Generally, it is an addition to our gross margin because of the accounting entry, but there is a non-cash effect of that. With that, we made the adjustment in this quarter. The effect was not that much, the effect of the VNR. But if it weren't for that, we would have a positive evolution of EBITDA from 192 to 203. But anyway, we know that there was a drop in the market by 12.1% in Rio and 10.7% in the Espírito Santo market. But these are mostly for free customers. So you see that in São Paulo, about 5.9% are the other markets, that is regulated. And when we see the breakdown, we see the highest tariffs, residential, that went up, and the drop that we had were in the industrial and commercial segments by 15 and 24 respectively, in both regions in which we operate or in which we have most of our operations. In terms of losses, of course, this is not a good quarter for losses, but it is very good for us to have that within a perspective. Just when we compare losses, we do see a slight recovery in the level of losses. EDP São Paulo closed the period with 1.35 terawatts hour in losses, which accounted for, in terms of total losses, an amount of recovery of 40 gigawatt hour compared to the same period last year. That is, remember that we have a 12-month analysis. In Espírito Santo, you're talking about 101.1 gigawatts hour of recovery. Of course, here we have a point that percentage-wise, we see an apparent worsening in the case of São Paulo, but that's very much explained because we had a drop in the market, a drop in market base. And remember that clients, industrial clients, have lower technical losses, and therefore we see an apparent drop in percentage, but not in absolute numbers. It's important to mention that we improved a lot our digitization processes. Uh, that's very important, especially for the provisions of bad debt, so addressing delinquency rates. And we had an improvement in digital search channels with in fact, an improvement of 70% when we compare to the numbers we had in the second quarter last year. Self-services increased a lot, and that enabled us to go through the crisis in a way mitigating the discomfort in terms of services to our clients. On the next slide, well, transmission, we have 71% of our capex already executed on June the 30th. EBITDA and adjusted EBITDA. When you take a look at our adjusted EBITDA, we had an evolution from 6 to 11. Remember that the book EBITDA is a record of our construction, so it is the regulatory EBITDA incorporating the what's in operation. So we have a total of 2.7 billion invested period so far. And the good news is that the main lots, 7, 18, 21, and Q have between 65 and 73% of construction evolution, not necessarily financial, but physical. And they had been stopped for some period of time, but now we have resumed our works, and we are at a level that is equivalent to the pre-COVID period. And we are very satisfied with the resumption of the pace of work, but also of our productivity. Next slide, please. Here we talked a bit of our stabilization. You see in this quarter, we allocated only 22% of energy with an improvement in the second and third quarters. Obviously, this quarter we had a different breakdown than what we expected uh, uh, because of the pandemic. Our seasonalization was not as expected, but still remember that we always have a strategy of mitigation of problems. We have our mitigators in place, and basically you see a drop of 23 million until the end of the year. We want to recover those indicators. And remember that these positions were not absolutely static. We had short position for the trading company, and these are now closed, but these are the dynamic moves that we have to make because of the market dynamics. Uh, but obviously, the COVID was not something that we had forecasted when we were thinking about the year, although we did have a very good results for the quarter. Next slide. Here we talk a bit about Pesang. Well, Pesang, basically, we continue the good work, and we're having consistent results from the plant. Uh, 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 we did not have any dispatches in the period, but it continues with an uptime above the FID. So that's what we want, the FID above 100%, and therefore up time above 83, 85, and we continue with the good performance, also adjusting our OPEX levels this quarter. And to talk about OPEX, on the slide, we have a drop of 8.2%. That was possible because we did first simple things. We addressed vacancies that had not been filled yet. Basically, we cut expenses in traveling and etc. We negotiated contracts in distribution, especially EDP São Paulo, in terms of meter reading, tree trimming. We had cuts in the company based on incentives of the government on unemployment subsidies. And we also worked a lot with our the field team in terms of maintenance. So it was a period in which we could fight losses and delinquency. We already are enjoying these cuts in August, but we were able to keep a level of revenues. In fact, our gross revenues went from 1.2 to 1.5 with relevant initiatives that we had. Again, maintenance of our reading and billing, flexibility of payment terms, the evolution of our digital channels that enabled us uh, to establish agreements because of the flexibility of the digital channel. So we were not downsizing. This was something that was uh, 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 something that we did not announce. Uh, but delinquency levels have not increased significantly. And of course, there was a higher credit risk due to the pandemic. We also basically regulated our recovery plans, and now we have a period of 6 months, 60 months. So uh, basically, with that, we're able to have even better delinquency numbers than what we had expected. Of course, this is a number that is still requires our attention, but it is not out of control. On the next slide, here we have basically how we are maintaining our leverage at about 2 times, and then the drop of indicators and rates that enabled us to decrease our debt cost. Remember that our gross debt is basically 10% part of paying and distributors indexed by TGLP. Then we have IPCA and CDI that did have a drop, and also uh, Miguel already talked about that. We had a reinforcement of our availabilities just to mitigate future risks because the market may be a bit more closed, any risk in rolling over our debt. Today, we have a cash and cash equivalent of 3.4 billion reals, but with that, we can meet our maturity schedule up to the end of 2021. And basically, this was an important move to mitigate any financial risks that we might have in such a complex period. And on the slides, and next slide, when we talk about our net income, basically, we had net earnings of 48 million above the same quarter last year, that is year-on-year, the highlight transmission. And in terms of equity equivalences, basically, we have Celeste with 28.8%. It represented 19.4 million in our results. And therefore, we have this recognition in our financial results, which in a way results into a positive consequence of the reduction of the drop in CDI and IPCA. And now I'm going to turn to Miguel to talk about the new dividend policy that was announced together with the results of the quarter. Well, thank you, Enrique. I think it is clear that we had a quarter, operationally speaking, that I would say was quite solid, with the results obviously affected by the pandemic. But above all, I think the word that stands out in the results is resilience. We persevered, we focused on minimizing impacts in our operations in the context we were always all going through, and we see the impacts of our actions, even costs, the efficiency that we were able to resume in this quarter in our cost structure management that are a result of our focus and the way that we systematically addressed each one of our cost structures, adapting our organization to the new reality and to today's situation, current situation. So much so that we closed some of our units in São Paulo, where we had institutional representatives, and we left offices and are now rethinking our new model in terms of institutional representation for São Paulo, for the company, and how we are going to allocate our human resources in the city of São Paulo. Now, if you allow me, I'm going to the last part of the presentation, which is to give you a bit more color on the changes that we made in our dividend policy. Basically, the changes have the objective of giving more clarity, more transparency in the end of the day to our investors with regard to the cash flows that we pay out in the form of dividends. And this safety does not remove flexibility, as you saw in the communication that we made to the market. But it gives us and to you maybe a clearer view on our operations. So basically, this change in the dividend policy is based on two principles: capital discipline and guarantee return to shareholders. In capital discipline, there is a commitment of us approving investments that will have a minimum profitability, and the way we measure this profitability is in the ratio between the IRR and the WACC of each initiative. That is a premium of 40% over the average cost of capital. So this was going to be our main criterion to approve investments. And that focused on the company's priority growth. There is networks that we call regulated transmission and distribution networks, and growth, which is the new downstream, as we call it today. And we focus here on solar energy, but other projects that in a more encompassing manner are included in this energy transmission, electric, everything that has to do with this transition to a new energy paradigm. So investment strategy with clear approval criteria and very precisely focus on our priority segments. Also, our guidance in terms of organic growth. And here we have two segments, distribution and generation. In distribution, the company's commitment to continue to make investments of 1.5 to 2 times the reintegration quota. In the past, we had lower level of investments, and now gradually we are stepping up in terms of organic investment in our distribution company. And in transmission, our commitment is to look into organic greenfield projects, especially by taking part in auctions. So basically, this is again clear guidance on how we view organic growth. And finally, in capital discipline, the commitment that I believe has been very critical in our strategy of being willing to engage into low volatility projects in regulated markets with long-term contract. That gives us cash flow predictability, and therefore it is the company's preference in being in these segments of low volatility. So these are the three most important points of what we consider capital discipline. As for return to shareholders, three very important points. The first is just making it clear what is a minimum dividend payout, which is not incompatible to what our dividend policy has been so far. We had the policy with the commitment of uh, paying at least 50% of the adjusted net income. And what we are saying now is that this committed is backed by an amount that is going to be not lower than 1 real per share. That is, as written in our policy, the dividend is going to be a most of 150% of adjusted net income, or the minimum payout in Brazil, which is 25%. And with that, we have a floor of payout that shows an important message to our shareholders so that it's very clear that we do commit to have a minimum payout of dividends. The second thing is that we have the commitment to basically pay out the remaining free cash flow. So the company has the ambition to continue to grow. It has investment plans. It sees investments in the future in regulated networks, the new downstream. So this is not a message that we do not have a prospect to grow. We do have the prospect to grow, but if by any means there is no growth contracted, what the company is going to do is to give back to shareholders in the form of a special dividend payout or a share payback the remaining amount. This is a commitment that was not clear in our policy, and it now is in a clear, explicit manner in this new dividend policy. And finally, and I'm going to go to the next slide because I think it is better explained on this slide. We have a commitment to keep our leverage between 2 to 3 times with a target between 2.5 and 3. So the objective would be for the company to have its objective leverage between a net debt EBITDA ratio of 2.5 to 3 times, but the minimum ratio again, it is a floor that would be 2 times net debt EBITDA ratio. This future prospect of showing our commitment for the years to come is very important at a time where the company does not have full visibility on its investment from 22 onwards. So we could be tempted uh, to model company capital structure with progressive deleveraging. This is not our objective. We want to keep an optimized capital structure for the coming years. And so we are giving clarity and visibility to this interval in between 2 to 3 times net debt EBITDA ratio, so that no one has any questions about our capital structure in the years to come. Henrique already mentioned we are at 2 times now. So if it is the case that the company has an ambition to have a much higher leverage rate, but we cannot be below 2 times. And that, I think, is a commitment that optimizes our capital structure. And finally, for the year of 2020, just to crown all that, because of course we have already paid out dividends of 2019 this year. We had a decision of the board of directors of EDP Brasil, and please go to the next slide, to start as of today a share buyback program. About 24,900,000 shares of the company. This amount, as you know, together, the company has about 2 million shares that it could use for its long-term incentives. That is, the company bought shares to be able to pay them to its management team, officers, first line leaders, and directors. So in addition to these 2 million shares that we have in treasury, the possibility of buying 24,900,000 shares approximately, to ensure that we are not going to go over the cap, about 10% free float with the program. And here, again, we see the company's awareness of uh, uh, this new dividend policy that is clearer to the market and is complemented to the share buyback program. So altogether, I think they will give more visibility and flexibility that will be necessary for the company, so that the company at each point in time can drive its resources to the investments it wants to make, but also uh, 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 giving guarantee to shareholders that when investments are not committed, that the remaining cash flow of the company will return to investors, will return to the market. I think this was a very positive and important step to us all. And obviously, we are at your disposal to answer any questions or that you might have, or any additional requests for clarification. Well, all that said, I am closing my presentation and I will open for your questions. Thank you, Miguel, Henrique. Okay, just to start with the Q&A, in addition to Miguel and Henrique, we have João Brito, our network BP, Joshua Rossi, our Energy Planning Officer, and Luis Falcone, our Foreign Officer. We have some questions already. I'm going to ask them. The first comes from Carolina Carneiro from Credit Suisse. Good afternoon. We saw a good performance in the quarter, which in a way was justified for less extra hours and less travel expenses. I would like to know if you are going to continue these savings because of your digitalization structure. Okay, I'm going to start the answer, and then if Felipe wants to complement, please be my guest. Yeah, Carolina, thanks for your question. Indeed, this is a set of initiatives. Remember that we talked about 50 initiatives, and most of them are focused on reducing costs. Some of these initiatives, as I mentioned, have to do with this new working model. The market is talking about the new normal. So we have initiatives, as I mentioned, which is to rethink the use of offices, all our fixed costs that are related to travel expenses, consulting, communication. So there is a rethinking the cost structure as a whole. I think I mentioned that before. We have a mission that is between 50 to 100 million of cost reductions. Today we are in between, but it can even get to three digits in terms of cost reductions. And as Carolina very well said, some of it can be definitive. Our commitment today, as you know, is to always, in a recurrent manner, and we have been doing that systematically uh, 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 with good results. The company has been really optimizing its results. We have an OPEX over net margin of about 26, 27% when we compare to our competitors. We are one at the lowest levels in the industry. So it's systematic work to reduce costs. But I would say, Carol, that our commitment to today is to be systematically below inflation. That is, to have real gains that enable us to do below inflation in the long midterm. Uh, and I think this is something that we hope to reinforce and continue to sustain a cost evolution below inflation. Henrique, do you have anything to add? Uh, Carol showed the 8% that was maintained. Of course, there are many things that are not going to be maintained. There are gains that were captured in our timeline. So Miguel mentioned, we probably have a 1.5 to 2% gain in the crisis in terms of what we are rethinking in a consistent manner. Uh, we believe that we have gains that go beyond this quarter, but we cannot keep all these savings. We have to be a bit more cautious about that. But there are things that I would like to mention. There are behaviors that are induced by the crisis with the means of payment, for instance, that are very positive. In São Paulo, we have more than 51% of our invoices that are being paid by automatic debit. So it went from 42 to 51. In Espírito Santo, also a positive evolution, but at a much lower level, 24 to 29. So these are behaviors that we believe are going to stay. Uh, uh, and that helps the company if the company facilitates those interactions, and it is something that we can seize benefits. Uh, 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 Digitization is a new pathway. This is not something that we just did during the pandemic. We've come a long way, and the results are good. Markets react well to that, and so we continue on our journey to digitization. The second question comes from Pedro Mortandini from Goldman Sachs. Good afternoon, everyone. I really thought the announcements of Friday were very interesting. We encourage other companies to follow the same path. I just have a question about the choices. One real per share and leverage between 2.5 and 3. With the CDI at normal levels, don't you think that the 2.5 is going to be closer to 3? And finally, expansion. Do you have any plans to go into the gas market? Thank you very much. Thanks, Pedro. I'm going to start answering, but then I'm going to turn to Enrique. And I'm going to start with your final question, Pedro. With regard to the gas market, effectively, in the past, we did consider the gas generation as an option, but today, as you have seen, EDP, the group in EDP Brasil, has been more and more assertive on green energies. Gas is a transition energy. We think it's necessary and important to the Brazilian matrix to have a gas energy to be able to complement intermittent generation with base generation. And in the case of gas, it can also work with some kind of flexibility. But right now, strategically speaking, EGP has a bet on renewable energies. Um, and that's why we are focusing on solar energy. We believe there are huge opportunities in Brazil, and growth is going to be exponential. So we are going to continue focus on renewable energies, most particularly on solar energy. So right now, gas energy, generation of electric energy with natural gas is not a priority, is not in our radar to have investments in this area right now. And even our commitments are towards decarbonization, decoaling. Uh, so the business ambitions is really to contribute to a decrease in Earth's temperature. So again, we're betting on renewable energy and less on fossil fuels or fossil fuels associated energies. Natural gas is an energy that is less impacting than oil or coal, but still we consider it as a transition energy, and we are no longer focusing on these kinds of energy. As for the dividend policy and the numbers we selected, well, this was a very detailed work developed by our financial and IR teams. It was a true deep dive the result of many months of reflection. So the numbers are the numbers that we understand as compatible to the company profile, and above all, that can keep a debt profile that is part of our strategy. That is to systematically being considered by rating agencies at the upper quartile in terms of credit quality in the Brazilian market. And we also understand that the leverage levels that would enable us to be at this level of credit quality would be between 2.5 and 3 times net debt EBITDA ratio. So we believe that this is an interval that gives flexibility to the company, but that also allows for a risk profile of quality and therefore a credit risk that is very much controlled by the company. And this is the result of this several dimensions. 1 real per share. Once again, this is the minimum amount so that when the company projects the future cash flows, we understand that this amount will enable us to meet the criteria of 50% of the net adjusted income. So these are amounts that are compatible to company projections to the future, ensuring the minimum payout of 50%, but removing uncertainties. Just imagine that there is 1 year that this amount is more affected. We can reduce the uncertainties of investors and pay a minimum. And then on top of this minimum, and I think this is the flexibility of the company, to complement the minimum with a special dividend payout or a share buyback program. So this 1 real is compatible to the 50% payout of the net adjusted income and will work as a floor that can be complemented by the company if that's the situation. I don't know if Henrique would like to add to the answer, but I'm going to turn to him. I think the questions are excellent. Uh, when we choose a number, the question always come up, why this number? I would say that we are having comfortable growth. We have our distribution lines. We have the transmission. We have our numbers revisited after the COVID with growth in cash and EBITDA. And this grows as we complete our transmission lines. And remember, this 1 real per share is the floor, but also it's important to tell the market something that we believe is important. Sometimes, what is this 50% of the net adjusted income? What are we talking about? So we have a confidence in a number that is easily understood. It is the floor and it is 1 real per share, and it is easy for everyone to do their math. So I think it's a consistency with our numbers and it is easy to quantify. And it's the message to convey. In terms of leverage, of course, our objective is 2.5 and 3. We are talking about interest rates. We do have the scenario. Uh, we do not want to change our risk profile. There are companies that live comfortably with a higher leverage. We historically have kept this more conservative leverage, and then our objective is 2.5 and 3. But the floor is important the remaining cash flow is going to paid out to shareholders. If you do the calculation without investment, you might uh, go beyond the 2 times. And so we went our growth in EBITDA because we are delivering transmission lines. We have distribution as contribution. And then the increase of leverage becomes more difficult because of the investments being made. And then it's important to make the statement of 2 times. So we even keep 2 times, we'll have to have additional payout of dividends, special payouts, or share buyback programs as we define clearly in our policy. So we thought it was important to make it clear, to make this statement to the market and to show deleveraging, and we are not going to deleverage beyond 2 times. And our projections were based on real life, and then basically this is a guarantee that we are offering. We do not want to deleverage beyond 2 times. and that's why we decided to do that. I hope I have answered, but anyway, if you have any further questions, don't hesitate to ask. Our next question comes from Gabriel Fernando, an individual investor. Thank you for the opportunity. Could you tell me what is the company's concern in terms of delinquency? Should we expect them to go up? João Brito, our distribution VP, perhaps can answer this question. Well, thank you, Miguel, Gabriel. Thanks for your question. Well, we are obviously in a difficult and challenging scenario, and I think our result has been consistent with our actions since the beginning of the pandemic. And the delinquency results we have had so far show that. First, we never communicated the end of the cutoff. We never sent this message to our clients in terms of energy cutoff. Also, we had a very strong presence in the media, both in the printed press and in the social media, how important it was to keep the company reinforcing digital channels as the safest way to pay electricity bills. We continue the regularity of our readings. We continued to visit clients to give their bills as correctly as in the past. We continue to send SMS to our clients to talk about the effectiveness and the maturity dates of each bill. And because we had teams fighting delinquency in preparation, and we now have a reinforcement of these teams uh, uh, from maintenance teams. So uh, basically, some teams that were working in maintenance were transferred to delinquency to fight delinquency. So we are expecting to have numbers that are worse than last year, but the idea is to minimize impact as much as possible. And also, negotiation of that, we have our digital agency, digital branch, uh, to give customers a certainness to negotiate their debts and use our digital channel that has a lower utilization cost and is more interesting to us. So these were the actions that we took that somehow enabled us to have delinquency rates that were not as bad as we expected. And we believe that now, towards the end of the year, we are going to have a slight improvement. That. So I hope I have answered your question, Gabriel. Our next question comes from Paulo Mazzuco. How does EDP monitor the growth of solar energy in the residential segment? Thank you, Paulo. This question is very interesting because basically this is a new market that EDP is has been getting into in the past 2 years. We believe that this market is a market that is going to show exponential growth in the coming years, and Brazil has very particular characteristics that makes this market quite interesting. Brazil geographically is a huge country, and so far we have no restrictions to install a solar project. We have solar levels that are record in the world. If you compare to solar levels in Brazil to Europe, to Germany, for instance, where solar energy is very popular, very usual, well, levels in Brazil are twice the amount that we see in other countries, as I mentioned, in Europe. So effectively, this is a market that has huge potential. EDP believes as a group that the B2B market, that is large corporations market, is a market that to us is a priority market. Obviously, B2C market, that is business to consumer, is a market that we intend to work in. But right now, the company focus is to serve clients, large clients, in what we call B2B segment, with whom we are developing projects in terms of installation of solar plants. These are plants that are not a high scale. They're 100, 200 megas. They can be between 1 and 20 megawatts. That is, they have a geographic scale that is quite significant and are very important to address the needs of large clients. An example, shopping malls that are all over Brazil, industrial clients that want to turn their portfolio a bit greener and therefore have some kind of solar energy. So we are not only looking at the distributed generation market, but also high production market. And therefore, we have quite ambitious objectives to grow our business in this area. So, to answer your questions, we are looking into this market. It's a market with huge potential, and it is a market in which we want to have a quite relevant position compared to the competition. Our next question comes from Itaú. Why do you think you grew less than other competitors? And the buyback program, uh, do you have you have a period of 18 months? Do you have any fear that after the 18 months you have not enough shares that were bought? Okay, I'm going to start to answer your questions. Uh, About the share buyback program, we have the authorization of the board to buy about 24,900,000 shares. This is a decision that will depend on the shares themselves. We have a maximum limit, that is, we have price caps, and if a price is above that, it makes no sense to purchase the shares. But we do not see any reasons for the company not to fill out this objective. In terms of prices, the company believes that this is a good investment. These are assets that we know the risk is known as well. So in our opinion, it makes sense for the company to allocate results and uh, 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 to enjoy the profitability that is implied in our stock prices. As you know, our shares responded to the announcement quite quickly, but in our opinion, we are still trading at a discount. So the share buyback program continues to be quite good to us. I don't know if João or Henrique would like to add to that. Okay, I'm going to add to that, and then João perhaps can complement my answer. Basically, to tell you what we are doing. Well, Marcelo, thank you very much. I think that what you said is very interesting. In terms of other companies, you know, if you think of the companies that are operating in the state of São Paulo, um, oh, that was not really different from ours. Other companies exposed to the different markets in the north and northeast had different results, but our results compare to those companies that are located in the São Paulo region. And I think that we did our homework. I would be quite cautious in terms of evolution of bad debt, in terms of what is to come, in terms of results. Of course, this is a factor of concern for all the business in Brazil. If the risk of credit increases and that can impact us. So I think this is something that is a concern for us all. And one note that perhaps is easier for us to clarify, if you think of how we register our losses, we have this concept of expected loss. Sometimes it's very difficult to measure the impacts immediately. So you have to have an average. We haven't seen a huge degradation in our delinquency levels a long time. Sometimes you have some fluctuations but by month, but um, uh, basically sometimes the information we received that numbers were even better than pre-COVID times. Well, all that to say, Marcelo, that perhaps it's a bit early to say that these numbers that we see are our definite numbers. I would ask João to add a bit to that, but I think that he can explain how active we have been to control those initiatives. Well, thank you very much, Henrique. Well, in addition to the initiatives I mentioned, we are continuing the readings and the visits to our clients. We never communicated that we were cutting off energy lines. We have the digital channels to talk to our clients. We want to keep communication with our clients by being of SMS, communication to the press, our presence in the social media. So all that contributed for us to present better results in the topic. Also, we have a daily monitoring in terms of collection rates, what it was like compared to previous periods, and how we could work on different customer segments and in the different regions. And of course, we are to be cautious because we know there is a possible higher unemployment in the second half of the year. So we are monitoring this topic with caution, but we are also enjoying the decrease that we had in maintenance to have more teams to monitor billing and collection, and therefore present better results in terms of bad debt and using technologies that enable us to have more productivity in field groups, optimizing our routes, and also steering some of these groups to work on bad debt. Well, thank you very much. We are now closing the Q&A session. Any questions that were not answered on this webinar are going to be answered by email. I thank you all for attending, and I'm going to turn to Miguel for his final remarks. Well, Marilia, thank you very much. I think this webinar is a bit longer than what we had expected. So my final consideration is just to thank you for those of you that kept here until the end, and see you next quarter. Thank you very much and keep safe.